Your financial advisor earned more from you this year than last year. Not because they had a new idea, not because they made a single additional phone call, just because the market went up and your balance is higher. That is the whole model. And once you understand the math behind it, you start to realize there is one conversation your advisor is structurally incapable of having with you, and it is the most valuable conversation in finance. That conversation is this: you know what? At this point, you genuinely do not need me anymore. In 2024, Sequent registered investment advisors managed $144.6 trillion in regulatory assets under management, a 12.6% increase from the prior year, the highest level ever recorded. The financial advisory services industry globally was valued at $218.96 billion in 2025. $218 billion, flowing largely from people who, in most cases, could legally get the same after-fee outcome from an index fund that charges 0.03%, 93% lower than its category average. 3 cents per $100 invested per year. I want that number to sit with you for a moment before we go anywhere. The point of this video is not to say all financial advisors are useless. Some of them are genuinely exceptional, and I will tell you exactly what separates them. What I want to do is expose the structural incentive that makes the mediocre ones expensive, corrupts the average ones quietly, and costs even the best ones their credibility on one specific point. The one piece of advice the model will not let them give you, not because they are dishonest, because the system makes honesty unprofitable. Here is what I am going to explain. The dominant payment model in the financial advisory industry, charging you a percentage of your assets every year, regardless of outcomes, creates a conflict of interest so fundamental that it corrupts the advice at the source. I am going to show you exactly how much that costs in real compounding dollars. I am going to show you the legal loophole that most investors have never heard of. And I'm going to show you where the industry's own justification for its fees quietly falls apart when you run the numbers yourself. I also want to be precise about who I am not talking to. If you have a business sale in progress, a complex estate, multi-generational wealth transfer, or cross-border tax exposure, yes, you probably need a financial professional, several, possibly. This conversation is about the average investor with $200,000 to a few $1,000,000 being told they need someone to manage it indefinitely when the evidence says otherwise. Let me give you one simple metaphor that I want you to hold on to for the entire video. Imagine you hire a personal trainer, not a metaphorical one, a real one. Gym, expertise, programming, the whole thing. But instead of paying by the session or by the hour, this trainer charges you based on how much you weigh. Every month, they put you on the scale, note the number, and send you a bill for 1% of that number in pounds. When you are heavy, they earn more. When you get lean, which is supposedly the entire point, they earn less. Now ask yourself, does this trainer have a structural incentive to get you to your goal as efficiently as possible? Of course not. They might be a wonderful, genuinely skilled coach, but the incentive is pointing the wrong direction. Getting you lean is bad for the business. That is the AUM fee model. Your financial advisor's income is a percentage of your portfolio. When your portfolio grows, even because of market returns, they had nothing to do with, they make more. When you reach a point where you genuinely do not need them, still paid by the pound, I am going to use that phrase repeatedly because it is the cleanest summary of why the advice you are getting is always, at every margin, subtly bent away from your interests, not through fraud, through structure. In a moment, I'm going to show you the one legal distinction that explains why most investors have no idea what standard of care they are actually receiving from the person managing their money. But first, let me show you what the scale problem actually costs in dollars. According to the 2024 Kitces report, 92% of advisors use an assets under management fee structure. A $1 million portfolio comes with a median AUM fee of 1.02% annually. That sounds like $10,200 a year, already not a small number. But the real cost is not $10,200. The real cost is everything that $10,200 would have become if it had stayed in your portfolio, compounding for 30 years. Here is the math. Take a $500,000 portfolio growing at a steady 7% annual return. Over 25 years without any fees, that portfolio grows to approximately $2.71 million. With a 1% AUM fee, the portfolio would only grow to about $2.15 million, a difference of $560,000. $560,000. You started with $500,000. You just paid the equivalent of your entire opening balance in compounding losses, not in fees in loss compounding. John Bogle, the founder of Vanguard, aptly called this the tyranny of compounding costs. Now extend to a $1 million portfolio over 30 years, and it gets worse. A $1 million portfolio growing at 7% annually, a 1% fee could shrink your portfolio by about 25% over 30 years, translating to nearly $1.9 million less in final value. Not $1.9 million in total fees, $1.9 million in the compounding those fees consumed. The advisor's annual invoice is the visible number. The invisible number is the one that should concern you. Here's another thing nobody puts in the brochure. As your portfolio grows, so do the fees, even if the advisor's workload stays the same. A $1 million portfolio incurs $10,000 in annual fees, while a $2 million portfolio costs about $20,000 per year, even though the level of service likely remains the same. The work does not double, the bill does. And since 2018, financial advisor fees have not been deductible for most individual taxpayers. The Tax Cuts and Jobs Act eliminated that deduction, and legislation has extended that prohibition beyond 2025. So you are paying after-tax dollars. On a $1 million portfolio, that $10,200 annual fee costs you closer to $15,000 in gross income if you are in the 32% bracket. There's a person I want to introduce to you now. I will call him Marcus. He spent 12 years as a financial advisor at a mid-size wealth management firm. Smart, genuinely cared about clients, good communicator, and somewhere around year 7, he started having a quiet internal conversation he was never having out loud with his clients. He would look at a portfolio mostly diversified index allocations, rebalancing once a year, performing almost exactly like the market, and think, this person does not need active management. The behavioral coaching, when markets crash, sure, maybe the occasional tax question, but the portfolio management, paying 1% for that? He described himself to me later as being paid to send quarterly statements with a professional header. He did not say this to his clients. He could not, because if he did, they might leave. The scale problem does not reward honesty. I am going to come back to Marcus. His story does not end where you expect. Stay with me, because this next part fundamentally changes how you evaluate every recommendation you have ever received. There are 2 legal standards that govern financial professionals in the United States. Most investors have never heard of either of them. The first is the Fiduciary standard. Under this standard, an advisor is legally required to act in your best interest at all times. Established under the Investment Advisors Act of 1940, the Fiduciary standard states that an advisor must put their client's interests above their own. They must follow the very best course of action, regardless of how it affects them personally, and their advice must be the result of thorough analysis, executed as cost-effectively as possible. They are also legally required to disclose any conflicts of interest that may arise. The second standard is called the Suitability standard. This standard is not nearly as strict. Advisors under it simply have to give advice that is suitable for a client based on their financial needs, objectives, and specific circumstances. Not the best option, not the cheapest, just suitable. They are not required to put their clients' interests ahead of their own, and they do not have to disclose any conflicts of interest that may arise. Now here is the number that should genuinely concern you. Less than 10% of financial advisors are held to the fiduciary standard, 10%. The remaining 90% can legally steer you toward higher cost products that pay them more in commissions, as long as those products are not completely inappropriate for your situation. The word suitable is doing extraordinary amounts of legal work in that sentence. Broker-dealers, insurance agents, and some financial planners may only be held to the suitability standard, potentially leading to conflicts of interest. The suitability standard was overhauled in 2020 when the SEC implemented Regulation Best Interest. While it stops short of imposing fiduciary duty, it introduces stricter obligations requiring broker-dealers to act in the best interest of their clients when recommending investments. But the enforcement gap between best interest disclosure requirement and legally bound fiduciary is where a significant amount of quiet money moves. Here's what this looks like in practice. You have $300,000 to invest. You walk into an office that uses the suitability standard. The advisor could put you in a mutual fund charging 1.2% annually with a 3 to 6% upfront sales commission. Commission-based advisors earn a percentage of the transaction value when selling financial products, with rates generally ranging from 3 to 6%, common for products like mutual funds, annuities, and insurance policies. Or he could put you in a Vanguard index fund that charges 0.03% and pays him nothing. Both options are technically suitable for a middle-aged investor with a moderate risk tolerance. The question writes itself. I'm not saying your advisor is doing this. I am saying the legal structure permits it, and you would have no idea because the word advisor is not a protected title in the United States. Anyone can use it. A broker with a sales license, an insurance agent, and a fully registered investment advisor with a fiduciary obligation can all hand you the same business card with the same title. The only way to know which one you have is to ask directly in writing. Are you a fiduciary under the Investment Advisors Act of 1940? Watch what happens. By the way, hit subscribe if you like this content. Otherwise, YouTube's algorithm will essentially never show you my videos again. And I say things like this regularly. This is the moment this legal gap, this 90% operating under a weaker standard, where the mainstream retirement industry fundamentally fails the average investor. Because even if your advisor is ethical, even if they are genuinely trying to help you, the model they operate under does not align their income with your outcomes, and no amount of good intentions corrects a misaligned incentive. Knowing how the fee structure works and knowing what to actually do with that information are two completely different things. I spent about 2 years going through 50 years of actual retirement data, sequence of returns, research, withdrawal rate modeling, portfolio construction analysis, and I turned it into something I called the Exit Code. It is a digital book, 8 chapters of pure research and math, no padding, built around one central idea, turning the question, can I afford to retire, from a feeling into a number you can calculate yourself. The gap angle on this is straightforward. Your financial advisor will not hand you a framework that makes you less dependent on them. They charge 1% per year of your assets to explain half of what is in this book. 2 of the chapters connect directly to what I have been describing. The first is what I call the 4% trap, the famous safe withdrawal rule that most advisors still quote in client meetings. Even though the updated research behind sequence of returns risk has seriously challenged its assumptions for early retirees, I built a dynamic withdrawal method to replace it, one that adjusts based on actual market conditions instead of a fixed percentage. The second thing worth mentioning is the lazy portfolio, a 3-fund allocation strategy with a documented performance history across every 30-year window in the data that I tracked, consistently outperforming the majority of actively managed accounts after fees. No advisor needed to execute it. You set it up once and mostly leave it alone. The whole thing is available through the link in the description. It costs less than a single hour with a mediocre financial advisor, and I mean that as a mathematical statement, not a marketing line. Every year you spend without a concrete exit framework is a year the math compounds against you. Now, 2007, Warren Buffett. In 2007, Buffett made a $1 million bet. He offered to bet that over a 10-year period, from January 1st, 2008 to December 31st, 2017, the S&P 500 index would outperform a portfolio of hedge funds when performance was measured net of fees, costs, and all expenses. One company stepped up. Protégé Partners chose 5 fund of funds, funds that themselves invest in a variety of hedge funds. In total, the active management side of the bet ended up representing the performance of over 100 different hedge funds, the cream of the crop. the best professionals Wall Street had to offer. The index fund was up 85.4% over the 9 years. Through 2016, 7.1% per year on average. The hedge fund portfolio was up just 22%. Fund A returned 8.7% total. Fund B, 28.3. Fund C, 62.8. Fund D, 2.9. Fund E, 7.5. Not a single fund outperformed the index. 3 of the 5 had average annualized returns of less than 1%. In his 2017 letter to shareholders, Buffett explained his thinking with a simple equation. If Group A, active investors, and Group B, do-nothing investors, comprise the total investing universe, and B is destined to achieve average results before costs, so too must A. Whichever group has the lower costs will win. That is not a controversial statement. It is arithmetic. Now, financial advisors are not hedge fund managers. The comparison is imperfect. But the fund manager's incentives make this worse, not better. Fund managers are evaluated on short-term performance, not long-term outcomes. That means they are not waiting patiently for the right opportunity. They are buying something with your money right away. Because sitting in cash for 2 or 3 years, even if that is the smartest move, is not good for their career. Their job security depends on looking busy. Yours depends on actually growing wealth. Those two goals are not aligned. The data confirms this. Among active funds, 38% beat their passive peers in 2025, after accounting for fees down from 42% in 2024, according to Morningstar's semi-annual active passive barometer. And over the 10 years ending in 2025, only 21% of active funds survived and came out ahead. 21%. The other 79% either closed, merged into other funds, or underperformed, and every single one of them collected their annual fee the whole time. Every dollar that leaves your account as an advisory fee is a dollar that never compounds. It does not just cost you that dollar, it costs you every dollar that dollar would have become over the next 10, 20, or 30 years. The drag is invisible on your monthly statement, but enormous over a lifetime. Marcus, by year 9, had started quietly restructuring how he talked to his most sophisticated clients. He was not telling them to leave. He was guiding them toward cheaper underlying fund options within their existing portfolios, replacing actively managed mutual funds with index-based ETFs, reducing internal expense ratios. His clients were still paying the same 1% advisory fee, but the total all-in cost was dropping. His book of business grew slower than the firm average. His managing partner pulled him in and asked why he was moving clients toward lower commission products. Marcus had been effectively making himself worth slightly less per dollar, managed by routing clients away from revenue-generating products. He left the firm 18 months later. This is where the story goes somewhere interesting. Here is where I need to slow down, because there is a legitimate counter-argument to everything I have said so far, and the industry makes it well. I want to take it seriously before I show you where it quietly falls apart. Vanguard, the same institution that invented the index fund, the institutional home of John Bogle himself, has produced research since 2001, pointing out how an advisor using their advisor's alpha framework can add up to or even exceed 3% in net returns per year to their clients' portfolios. 3%, more than the advisory fee. On its face, strong argument for paying 1% to keep 2. Adding potentially 100 to 200 basis points of value on average, Vanguard believes behavioral coaching is one of the most crucial elements of advice helping clients avoid emotionally charged decisions, particularly during market volatility. Tax-efficient investing, disciplined rebalancing, and smart withdrawal sequencing round out the rest. According to Vanguard's framework, the greatest value is not from beating the market, but from guiding investor behavior and aligning strategy with purpose. Here's the thing. That framing is real. DIY investors often lose about 1.2 percentage points annually due to behavioral mistakes, as observed over the decade ending in 2024. If you sold everything in March of 2020 and then bought back in June, an advisor who talked you down from that ledge just earned several times their annual fee in a single conversation. That is a genuine value proposition. But you think the problem is that investors lack behavioral discipline and that financial advisors solve it. That is what the Vanguard paper argues. That is what every AUM fee advisor will tell you when you push on the fee question. The actual problem is different. A 1% annual fee is not just a cost. It is a constant source of cognitive pressure for the investor. When you are paying $10,200 per year or $16,500 all in on a $1 million portfolio, when you include fund expense ratios, you feel every dollar in fees as a dollar that misses the opportunity to grow. The compounding drag is not just mathematical, it is psychological. Investors in high fee arrangements watch their performance numbers more anxiously, not less. They calculate whether the fee is worth it constantly. They second guess the strategy more. The fee that supposedly buys behavioral coaching may be generating exactly the anxiety it claims to address. And there is a second part to this reversal. The behavioral coaching benefit is almost entirely available for free. Fee-only financial planners who charge by the hour, books, low-cost robo-advisors, direct guidance from resources like this. The idea that rational, unemotional investment discipline is exclusively accessible through an ongoing 1% annual contract is not supported by evidence. It is what the industry charges for. Those are different things. This is your first comedic cutaway. The actual pitch made literal. You are emotionally impulsive with money. So we are going to charge you $30,000 over the next 3 years to tell you not to panic. The panic may be partially caused by watching that $30,000 leave your account. But do not think about that. That is exactly the behavior we are coaching you out of. A used car dealership has better incentive alignment. This is where it gets genuinely interesting. Because once you peel back the behavioral coaching argument, what you have left is tax planning, estate coordination, and periodic rebalancing, all of which are real, valuable services, none of which require a percentage of your assets as a pricing model. A $3 million portfolio with traditional AUM pricing at 1% costs $30,000 every year. The same portfolio with a flat fee advisor might cost between $5,000 and $10,000. The tax planning does not get 3 times better because you have 3 times the assets. Hourly financial planning rates run between $200 and $400 per hour, and detailed comprehensive financial plans with flat fees range from $7,500 to $55,000 as a one-time engagement. One time, not every year, not compounding against you. For the vast majority of investors in the accumulation phase, people in their 30s, 40s, and early 50s, who are still building an annual retainer of $3,000 to $5,000 for a fee-only planner covers almost everything the ongoing AUM relationship covers, minus the scale problem. Let me make this concrete. I want to walk you through the numbers for someone I will call David, 44 years old, software engineer, Austin, Texas, has been contributing since his early 30s. By 44, he has $400,000 in his 401k and $120,000 in a taxable brokerage account. $520,000 total. 2 years ago, David hired a financial advisor, 1% AUM. The advisor put him into a diversified mix of actively managed mutual funds, internal expense ratios averaging 0.7%. So David's total all-in cost is 1.7% per year. He gets 2 formal meetings a year and access to a financial planning portal. He thinks he is getting a deal because the market is up and his balance is growing. Here's what David does not know. When you include fund expense ratios and platform fees, the total cost can climb to around 1.65% per year or $16,500 annually on a $1 million portfolio. David is at 1.7% total on $520,000. That is $8,840 per year leaving his portfolio. Against a benchmark of 0.03%, the VOO expense ratio, his comparative cost, is about $8,690 per year in extra drag. Over 20 years, the compounding difference between 1.7% all in and 0.03% all in on a starting balance of $520,000 at 7% gross returns is approximately $240,000 in lost compounding, more than his entire taxable brokerage account. Gone. And David's situation is not complex. One employer, no business, No estate planning issue. Standard tax situation. He is accumulating. The advisor is doing almost nothing his portfolio would not do on its own with a properly structured rebalancing index allocation. But the quarterly deduction goes out silently, slightly reducing the base that compounds the following quarter, still paid by the pound. The advisor is not a bad person. He is doing exactly what his business model requires. David just does not know he has a choice. Second comedic cutaway. Imagine a doctor who charges you 1% of your total net worth annually for a routine physical. Heart looks good, blood pressure is fine, markets are up. You leave. Next year, if you earn more money, if your business had a good quarter, the bill goes up. The doctor's expertise did not increase. Your health did not get more complicated. You just have more assets. The AMA would never allow this fee structure. The SEC, with some caveats, is largely fine with it. 3 practical takeaways specific to this topic, not diversify your portfolio generic advice. First, before your next advisory review, ask for a full breakdown of your all-in cost. Not the advisory fee alone, every fund's internal expense ratio, trading costs, platform fees, then compare each holding to its direct index equivalent. If the cost difference across the portfolio exceeds 0.5% annually, you are paying for active management. You are almost certainly not receiving returns to justify. In 2025, only 38% of active funds beat passive peers after fees. Ask your advisor which bucket their fund selections are in. Second, ask your advisor directly in writing, are you a fiduciary under the Investment Advisors Act of 1940? If they hedge the answer, qualify it, or pivot to, I always act in your best interests without confirming the legal standard, you now know what standard applies. Non-fiduciary financial advisors operate under the Suitability standard, which requires recommendations to be suitable for the client's needs, but does not require them to act in the best interest of the client. That is a legal distinction with 6-figure financial consequences over a decade. Third, run a 30-year projection comparing your current all-in costs to a 3-fund index portfolio, total US market, total international, and total bond market at approximately 0.05% average expense ratio. Use the SEC's own compound interest calculator, not your advisor's projection tool. The fee column on your current arrangement over 30 years will likely exceed the cost of your car, possibly more than 1 car. Here is how Marcus's story resolves. He left the firm in 2022. He now works independently as a fee-only planner, flat fee structure, charging a set yearly rate regardless of portfolio size, between $3,000 and $7,000 per year depending on complexity, with explicit communication to clients that once their financial plan is in place and their behavior is stable, they can reduce engagement to once a year or stop entirely and implement the plan themselves. His client base is smaller, his income is lower than it was at the firm. But he told me something I have not forgotten. He said the first time a client came back after 12 months and said, I think I am good from here. And he looked at their situation and genuinely agreed. That was the first time in his entire career he felt like he had done the whole job. Not half of it, the whole thing. That conversation. The one the AUM model structurally prevents. Studies indicate that a skilled advisor may generate additional returns through behavioral coaching, tax planning, and strategic rebalancing. Behavioral coaching alone contributing around 1.4%, financial planning adding 1.13%, tax management bringing 0.68%, and rebalancing contributing 0.28%. Those numbers are real. The question is whether you need a 1% annual contract with someone who is also incentivized to keep you dependent, or whether you can access the same services through a flat fee arrangement and a few good books. The math tends to favor the second option. Not always, but most of the time for most people. The industry's AUM model is not a conspiracy. It is a business model that evolved to solve a sales problem. How do you get clients to stay with you permanently? The answer was elegant. Just tie your income to their assets so that asking you to leave means admitting the relationship was never about their outcomes in the first place. Nobody designed it to be predatory. It just works out that way mechanically. RIA firms of all sizes saw significant growth in 2024. AUM increased 16.6%, Revenue was up 17.6%, and client growth was up 4.8%. The industry is doing exceptionally well. The clients it serves, that depends on which clients you ask and which specific advisor you are evaluating. What I want you to take from this video is not outrage. I want you to take a framework. 92% of advisors use the AUM model. Fewer than 10% are fiduciaries. Only 21% of active funds survived and outperformed their benchmarks over 10 years, ending in 2025. Those three numbers define the structural problem. The fourth number, the one that defines your personal situation, is your all-in cost, which you now know how to find. And the fifth number, the one the industry does not put on any brochure, is what that all-in cost becomes after 30 years of compounding against you. Lazy investing built more fortune than crypto memes. And the most expensive financial advice you ever received was probably the advice you paid for every year without knowing what you were paying.